You need to write this down. This is the meat and potatoes of what we're going to do. This is the trading criteria. Now, we talked before that the public perception is that stocks are more valuable when they have the potential for earnings growth. If you watch anything or read any books about investing, they all say this. Earnings growth, earnings growth, earnings growth. So, because the general public believes that, I want that to be your first criteria when you select a stock. It doesn't matter if the company is losing money or making money. What matters is that the earnings are going up. Why? Because that's what the public wants to see. So, your stronger stocks that are going to be able to generate more excitement is going to be the company who was losing 50 cents a share last quarter, but this quarter they're only losing 25 cents a share. Now, they're probably on their way to bankruptcy, but the general public perceives that a company that's losing less money this year than it lost last year is growing. And that may actually be true. I'm not going to argue with that. All I'm telling you is earnings growth is your first criteria. And you want to see like 30% earnings growth. Doesn't matter if the company's losing money. All that matters is that it's losing less money or it's making more money, and that number is significant because that drives excitement. The next thing you want to have is a 300% spike in daily trading volume. When you see a 300% spike in daily trading volume and earnings growth, that's exciting. You also want to have a rising on-balance volume line, a recent new high on the on-balance volume line, and that also applies to the price-volume trend if that's what your software uses. You want the chart to be smiling at you. If you see smiling price activity and smiling volume activity, that chart is friendly. You don't want to see any new low prices for about 60 days. I'm going to show you what that looks like on a chart, but in your mind, picture down, 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 down. Those are all successive lows. And then sideways, 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 up, sideways, 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 up. 60 days, no new low. When you see that, that's a good indication that the markdown phase has ended. When you see that in conjunction with everything else, that's an indication you're in accumulation. Now, the other thing that I want you to be able to see before you place a trade is a future entry point that is clearly visible. Now, what are entry points? Well, you're looking at a chart, it's moving sideways. An entry point is the area right above where it's moving sideways. That's going to be the top of your 21-day channel. If you're looking at your chart and you're like, if this stock breaks out right there, I'm going to buy it, that is a clearly visible entry point. It's going to be clear. You're not going to have to guess. If you're looking at a chart, and we're going to look at a lot of charts before this is over with, and it's moving sideways, and then there's a shakeout, and then it pops up, and then it bases, right above that base is a clearly visible entry point. It's going to be obvious. When you see those things, that's your trading criteria. Earnings growth, 300% spike in daily trading volume, rising on-balance volume, recent new high in on-balance volume. The chart is smiling, no new low for 60 days, clearly visible future entry point. Let's talk about placing the trade. We're going to trade stocks as they move up in price on the long side. And on the short side, we're going to sell stocks as they fall in price. So in order to accomplish that, we place a buy order above the current price activity. And that forces price to have to go up through our order before we get in. Why? Because a stock that's moving sideways is boring. And buying a stock that's moving sideways is assuming risk, and we want to assume as little risk as possible. Therefore, we keep our money in the opportunity box, which is cash, waiting for a breakout of excitement to go into the risk box for a period of time while the stock moves up. So, the stock moves sideways. Your order is here. It moves up. Your order is triggered. Now you're in. Now you own a stock where there's excitement, there's rising price, and if you've done everything else right, you're going to place a stop loss below just in case it's a sucker's rally so you don't get cleared out. And then you're going to let the market do the rest of the work for you. How much money should you allocate to each trade? So that's a challenge. And the challenge is because it really depends on your account size. In my account size, I don't like to risk more than 2% of my account value. So that means that the vast majority of trades I enter into are gonna be less than $2,000. Sometimes it's more, sometimes it's less. It depends on how much margin I have available at the time. Is that the right criteria for you? Probably, unless you're just beginning and you only have maybe $1,000. If you only have $1,000, it's not going to be very practical of you to risk 2% of that $1,000 to place a trade. It could still be done. Robinhood allows you to trade commission free. It'll give you some practice, but if you have $1 and you get a 300% return, you've made $3. I don't know that that's worth the effort. But if you only have $1,000 and you're just starting out and you have a job and you can afford to put some risk capital in, then what I want you to do is pick a number that's not going to make you cry if you lose the money, because even with everything in your favor, you're still going to get stopped out. It's still going to happen. It seems to me that the minimum amount of money that you can get excited about in a trade, depending on the price of the stock that you trade, is going to be about $200 or $300. With $200 or $300 as the maximum risk in your trade, if it goes against you, you get stopped out, you lose the $300. It might take, depending on your income level, another month or two to get some risk capital back, but it doesn't destroy you. If you have a $100,000 account, trading $200 or $300 at a time probably is not going to generate enough excitement to keep you interested. Then you're going to move to the 2% rule. As your account value goes up, if you stick to the 2% rule, with successful trading, the amount of money you're going to risk with each subsequent trade is going to go up, because you're always going to risk 2% of your capital. If you're going through a period where you're making some mistakes or the market is not in your favor and you're losing money, well, guess what? The amount of risk that you're going to take on each subsequent trade is also going to go down, because 2% of a $100,000 account is $2,000. But 2% of a $50,000 account is $1,000. So you will automatically adjust the amount of your bets based on the value of your account. When you have a smaller account, let's say under $10,000, you probably want to stick to a fixed figure, whatever your car payment is, or half of your car payment. You know, in this case, you do $300, $600. I don't know what your car payment is, but usually your car payment is a reasonable approximation of how much money you can flush down the toilet every month and not cry. Risk per share equals the entry price of the stock minus the lowest low price for the last 21 days. That's why we put that channel on the chart. So you're going to look at your chart. You're going to find where the stock is currently trading at, or where you think your entry price is. Then you're going to find the lowest low for the last 21 days, and you're going to subtract it. And whatever that number is, that's how much money you're going to risk per share. Then you take that amount and you divide it in to the dollar amount that you're going to be willing to lose. And that tells you how many shares to buy. It's no longer the case that you have to buy 100 shares at a time or 1,000 shares at a time. Those days have been long gone. You can buy 1 share of stock today and they don't charge you any more commission. I'm not recommending that brokerage, by the way. I have an account there, but I will show you where I do most of my trading. That's just an example. Okay, so we're going to take our risk amount, 2% of our account value. We're going to divide that by our risk per share. That's going to tell us how many shares we're going to buy. So let's just say it's 44 shares. Okay, then you place your order, buy 44 shares at such and such stop price. And when the market goes up through that price, your broker buys you the 44 shares and you're in. In small accounts, trade an amount that you're willing to lose without getting discouraged, because not all trades are profitable. Place a stop order at the price level where you believe the markup phase has begun, and then the price will put you in the market. Trail your sell stop loss order behind the rising price. And we're going to use that channel that we put on the chart as a guideline to know where to place that order. Remember, if a stock is going to go up, it's going to go up several times a month, and it's not going to make any new lows. That's just the way it is. In order for a stock that's worth $1 to get worth $10, it first has to be worth $2, and then it has to be worth $3, and then it has to be worth $4, and then it has to be worth $5. And if at any point on that climb it turns around and goes back to 1, there's something wrong. You don't want to be in anyway. That's the whole point of the trailing stop loss. But you want to give the market room to breathe, which is why we use the channel that gives the market room to fluctuate so you don't get stopped out unnecessarily. Generally, if a stock makes a new monthly low, it's going lower. That's it. That's the point. That's why we do it that way.